Welcome to the video on using moving averages using technician software. Although stock prices follow trends higher and lower, they can be quite volatile. For example, for several years after the financial crisis in 2008, the long-term trend in stocks was to the upside, but medium and short-term trends, such as the 2011 correction, can move in exactly the opposite direction. To smooth out this volatility, the moving average is used. There are several types of moving averages. The most basic is the simple average, which takes the prices from the previous user-defined number of periods, sums them up, and divides by the number of periods. A 10-day average is simply the average closing price for the past 10 days. Each successive day is calculated fresh from the 10 most recent days, and this is how the average moves. The number of periods to use in the average depends on the stock being analyzed. Typically, it is related to the cycle of the underlying item, such as a 10-month or 200-day stock market cycle, or for commodities, a seasonal heating oil cycle, or an agricultural harvest cycle. It also depends on what your time frame is as a trader. If you're a longer-term trader, obviously you're going to use a longer moving average. The average is then overlaid on a price chart, and crossovers between the average and the price are observed. When prices are rising, they are usually above the average, and this is to be expected since the average includes data from previous lower price days. As long as prices remain above the average, there is strength in the market. Buyers are willing to pay more for the stock as the market continues to value it higher. When prices cross below the average, it means that the market no longer expects prices to continue higher, at least temporarily. The more market participants taking this new view, the higher the volume will be and the better the signal. So in this chart of Coca-Cola, it's a daily bar chart for about 2.5 years with a 100-day moving average. Using a 100-day instead of a 200-day, because when the stock is this volatile, the average itself isn't going to jump around or react as quickly. Rather than look for trading signals when price crosses average in this particular chart, it's better suited to finding overbought and oversold conditions when price moves too far from the mean. And that's, for example, a case here. Look how far away from the average it is. Crosses through and goes all the way down here where it was oversold. Now, other indicators, such as momentum, would have maybe triggered a buy signal here, a short-term buy, and again down in this area. But the point is that when the average is flat, you're looking for more overbought and oversold readings, and when the average is rising or falling, then you have a trend line proxy, and you can use it just like a trend line. Here's the same chart with the same 100-day simple moving average in red, and a 100-day weighted average and exponential average in the colors as shown. Since moving averages are lagging indicators, they summarize previous data and plot it on current prices, so an analyst using only moving averages will probably not be able to call tops and bottoms. He or she will see the change in the trend only after it has happened. The good news is that the potential profit lost by the inability to pick tops and bottoms is offset by the reduction in volatility seen here and the reduced risk of making a bad trade. In order to reduce the lag of the simple moving average, we can assign more weight to recent data and less to older data. A weighted 10-day moving average, for example, assigns a weight of 1 to the first day in the series, 2 to the second, and so forth until the most current day has a weight of 10. The 10 weighted values are added together, and the sum is divided by the sum of the weights, which in this case is 55. Exponential averages are similar to weighted averages, and then they give more importance to recent data. The difference is how it assigns the weights. It's not important that we know exactly what the formula is, but let's just say that each day is more exponentially, as the name says, or geometrically weighted, whereas a weighted average is linearly weighted. So the most recent days in exponential average really get the most weight. So in the previous chart we saw of Coke, the 100-day average is used as a proxy for trend. In this chart that we have up now, we can see how the two weighting methods create progressively more sensitive averages that react faster to changes in that trend. And just for illustration, here's the red simple average, and you can see it's well away from the prices at the point of the cursor, where the weighted averages are much tighter to the trend, and price, when it does break through, it happens a lot sooner than having to wait for down here. Some markets react differently in bull and bear markets, and for these it is useful to base moving averages on high and low prices instead of closing prices. For example, to confirm a new bull market, the analyst might require prices to cross above the moving average of the highs, and this adds additional filtering of volatility without having to use longer and less sensitive averages. This leads us to moving average envelopes, which are simply pairs of moving averages above and below price. Sometimes envelopes are referred to as trading bands. In this chart, Gilead Sciences was in a strong bull market, and penetrations of the lower band led to 2 corrections and 1 arguable bad signal. So a big correction here and a really big correction here, and this one is arguable, and you would probably had to use other indicators to figure out what to do here. Envelopes are also created by taking a moving average of the close and adding or subtracting a certain percentage of the average value. They will grow as the central price increases and shrink when the central price decreases. So perhaps a 2% band, where you have the upper band moving at 2% above the moving average and the lower band, of course, 2% below. And Bollinger Bands take that to another level, because these envelopes are defined by standard deviations instead of percentages. So the width of the bands are determined by volatility rather than a fixed percentage. This study is described elsewhere in the Resource Center. Moving averages are really proxies for trends. So if you're a long-term trader, you want a longer average. Short-term trader wants a shorter-term average. And while you can get buy and sell signals as price crosses above and below these averages, and you can find support and resistance when price does bounce off an average or climb up to it and then get rejected, I would prefer to use these as proxies and guides rather than hard trading signals, and I would use other indicators to confirm.